We're running the numbers.
Hey, projections, right?
I'm just doing the math.
All very acidic, above the shoulders mustard.
Whatever you want to call it. You already know that in multifamily real estate investing, one of, if not probably the most important skill you can possibly have is the ability to effectively and efficiently analyze potential investment properties to know if they're actually worth pursuing or not. This is why I put together a free page of resources called Chicago Multifamily Analysis Made Easy. It gives you everything you need to know to quickly analyze 2 to 4 unit buildings, specifically in the city of Chicago, in 2 minutes or less using just a couple key pieces of information. Imagine knowing in just 2 minutes if a Chicago 2 to 4 unit building is a cash cow or a money pit. It's the exact same method and the exact same tools I use every day to analyze every new listing in the city for my clients and my subscribers. This free resource will save you hours of time and help you avoid costly mistakes. Somewhere in or around this video should be a link to download a PDF. This PDF contains the resources you'll need to pull this off, and then the rest of this video will be a tutorial on exactly how to use those resources. So I'm going to give you a few seconds now to go download that PDF and then come back here when you have it. All right, that seems like enough time. So here we go. Let's go ahead and get into it. Here's what the PDF looks like as of the time I'm doing this. By the time you download it, maybe it looks a little bit different, but for the most part, the information contained should be about the same. Before we get too far into things, I should probably tell you a little bit about myself. So my name is Jake Lyons. I am a real estate investment advisor and broker with At Properties and Christie's International in the Chicagoland area, Chicago mostly. Been doing this for about 8 years now. And before I got into real estate, I was a Series 7 licensed financial advisor, helping people plan their finances with securities, stocks, insurance, retirement plans, things like that. It was through this financial and analytical lens that I began to see the power of real estate investing, specifically in this 2 to 4 unit residential multifamily space, and saw the power of this for reasons that we will be getting into as we go along. So all this to say, I'm a very numbers-based analytical person. That's the lens I see all these things through. Well-informed, data-driven. That is my slogan for a reason. I realize that not everyone is necessarily wired that way. So before I begin to get into the DIY resources, at some point while I'm explaining the process of how to do this yourself, it's understandable if you get to a point where it seems overwhelming and you just want a service where this is done for you. And I want to point out this newsletter I offer, where I do all of this work for you every day by analyzing by hand each new 3 to 4 unit property in the market of Chicago and break it down into a small handful of easy to understand metrics that you will understand a lot better by the end of this video. But regardless, I'm just going to go ahead and skip to the end of this list of resources here and show you the newsletter just so that you know that it's available. So it's going to be here, the Daily Chicago Multifam Newsletter. Go ahead and click on this. It'll take you to this page right here. This is where you can sign up. I have different tiers based on how timely you want the information. So I have a free version of the newsletter. That's where you get information 10 days after these listings are put on the market, 10 business days, 2 weeks, however you want to look at it. Level 2 is a paid subscription. That one, you get the information within 3 days. So if you're a little bit more serious and ready to make a move, that could be a good option for you. But the best option would be if we are working together on a client-agent relationship level. And with those people, you get this information within 1 business day of the properties coming out so that you're ready to hit the ground running pretty much as soon as this information is available to anyone. Here's just a little bit about what it looks like. Here's just a quick example of the kind of information that you can find. It is broken down into the sections of the neighborhood. So I have far south side, west side, northwest side, north side, southwest side. I don't do downtown because there are hardly any buildings, 2 to 4 unit buildings in the loop. In fact, there are none. There are a couple in River North and places like that. So you will see those if they come up, but those are few and far between. Anyway, so these are broken down into, you can see the address, what neighborhood it's in, the price, the cap rate, which is, if that term is foreign to you, you will soon know exactly what that means, as well as the cash flow and the gross rent multiplier, another kind of industry jargon term that you will soon know what that means. Regardless if you decide to sign up for that, though, I encourage you to follow along with this and learn to do it yourself. The classic, teach a man to fish versus give a man a fish kind of deal, or woman, or non-binary, however, whatever you are. Any human who wants to purchase a 2 to 4 unit property is okay by me. So first on this list of resources is my Zenlist link. So Zenlist it's pretty similar to, if you've ever been, most of you have probably been to Zillow or Redfin or realtor.com or, appproperties.com or anything like that. It's it's not exactly like that, but it's a lot like that. But it's a little different. This is the industry leading home search portal that, in my opinion, beats anything available on the internet in terms of the number of properties available. It has access to listings that are not available to the public yet. Listings that are on what's called the private listing network, or otherwise known as the PLN. It's like this gray market, so to speak, where brokers can put a property on the PLN that isn't quite ready to go to the public market yet. There's a lot of different reasons they could do this. Maybe they're testing out price points. They just want to do like a soft launch while the seller is getting the property ready, getting pictures done, things like that. There's a billion different reasons why somebody might want to do it. But in any case, it's not available to the general public unless you are going through Zenlist or an agent with direct access to the MLS. So that's a huge, huge advantage to anybody that has access to that. Obviously, you want access to places before other people have access to them. That's goes without saying. It also lets us communicate directly about specific properties instead of you go to one of these other internet online search portals, you put in your information because you want to see more information about one of the properties. Suddenly you have like 10 random agents hitting you up talking about, hey, so you're interested in some property or whatever. I know I've been that agent. That might be how I met some of you watching this video. I'm not sure, but in any case, I'm getting away from that form of marketing because I just don't think it's what anybody wants. Certainly from my perspective as, the consumer in other situations, I know that that's not what I want. So, going through Zenlist will decrease that considerably. You're pretty much, if you go through my portal, you're only dealing with me. And you can submit requests. We can have little chat rooms specifically about specific properties, submit showing requests, things like that. And what this actual link will go to when you click on it is this. So you have to request access. Once you request access, I would highly recommend that you reach out to me. There's a billion different ways to reach out to me. You'll have my email, my phone number at the bottom of that email. Would highly recommend you schedule a consultation with me any way you want to do it. But it's important that I know what exactly you're looking for so that I can go in and make sure that your Zenlist account is set up correctly, because there's a ton of different criteria, lots of different things that can easily be missed if you're not in the weeds doing this every day. And, I don't want that to happen to you. So I want to make sure that you're getting the most out of it. So just, drop me a line once you request access and I'll make sure that your account is set up and ready to go. The second resource on here is the Chicago Multifamily Analysis Template. This is the star in the center of the solar system of all these other resources. So we're actually going to come back to that later once we have established a little bit more of a foundation of what these other things are. It's basically just a big calculator spreadsheet that is specifically formatted to the city of Chicago in really unique, cool ways. That being said, the one after that is going to be Rentometer. So if you are not familiar with Rentometer, don't know why you would be unless you have been doing this for a while. But in any case, Rentometer is my go-to rental comp portal. So when you click on this, it will take you to this page right here. So this is very valuable if you run across a property where you don't know what it is currently renting for. If it's vacant right now, or maybe it's not vacant, they're renting it out, but the units are well underpriced, under market value. Maybe they're getting $1,000 a month and you know that the market should be more like $2,000 a month. So you can come in here and run these reports. So you would come in here, put the address in, and I'll go a little bit more in detail about all this a little bit later when we are doing a run through using a real property. But basically, you come in here, you put the address of the property that you are interested in, how many bedrooms and bathrooms that each unit in the building has. So maybe you might have to run this report, 2 or 3 times if a building has a mix of different unit types. Put your email, put your name. You can put your phone number interested in if you want. I don't believe those are required, but definitely put your email and your name, and it will send you a report. And we'll take a look at what those reports look like a little bit later. Now, usually Rentometer will run you a few $100 a year, but because we're buds now, you can actually use this link and get these reports for free. So that is Rentometer. The next resource on this My Chicago Multifam Made Easy PDF is the Chicago Neighborhood Investment Grade Guide. In the real estate investment community, it's very common to hear people refer to different kinds of opportunities and challenges that specific areas have in terms of letter grades, literally A through F, like you're back in grade school. The lower the letter, like A's, B's, typically the more that area is associated with things like higher purchase prices, higher incomes in the area, higher levels of education in the area, lower vacancy rates, stable or growing prices, etc. While the higher letter grades, C, D, F, represent basically the opposite of that. This guide is all of Chicago's 77 community areas broken down by letter grade, along with the explanations of how each one got that grade. Took me a long time to do this. I'm very proud of it. I think it's a phenomenal resource to anyone who is interested in investing anywhere in the city, especially if you're interested in multiple different parts of the city. All this being said, it is important to note two different things. So the first is that I went through great lengths to ensure that this is based on consistent, objective data and not at all influenced by my personal opinion of any of these areas. Now, to do this, I relied on Scholar GPT, which is kind of like a subset of Chat GPT, that it specializes in synthesizing public records and academic data. So in fact, if we're being honest, it gave me some answers for some of the community areas that I didn't really agree with, but for the sake of objectivity and fair housing compliance, I honor what the AI overlord said in this situation and just determined to roll with that for the purposes of this guide. The second thing to note is that this is not meant to be like a moral judgment on anybody or any place. It's simply a shorthand metric to determine the economic realities of a particular place at a particular time. So basically, it's all about risk exposure versus expected return. A good way to think about it would be to compare it to bond ratings. I don't know if anybody has ever gone out and just invested in a bond, unless it's a part of like a mutual fund or retirement target date fund or something like that you're invested in or something like that. Not many people are going out and investing in individual bonds like that, but obviously, I'm a former financial advisor, so let me let me cook a little bit here. If you go to buy a bond from a company or government issue bond or anything like that, you'll see that Moody's and or Standard and Poor's or so some kind of rating agency like that has given it a rating. For example, Standard and Poor's, a AAA bond is thought of as the safest possible bond, and will also pay out the lowest interest rate of any bond because someone investing in that, they're not looking for a big high rate. They're not looking to swing for the fences or, go for some big home run play. They're looking for safety and stability. A rating of triple C would be thought of as a junk bond. The underlying issuer of that bond has some pretty serious underlying issues that the rating agencies are warning investors of, and anyone buying those bonds will require a much higher interest rate to make up for the perceived risk that their investment could go badly. And it works the exact same way here. So that all being said, this is what this resource looks like. It analyzes basically wherever ChatGPT went and got their information from, which, academic research, public records, other reliable sources, according to them, to assess different things like demographics, crime rates, different amenities that are in the area, population trends. Is the population in that area growing or declining? And real estate market trends. So, what are price growth and rental growth and all kinds of things like that. And then you can read more about the methodology of how this all was done, about Scholar GPT and how that works, AI and how that works. And then it gets into the different community areas. So starts at A and works its way down. So that's pretty much that. This is a pretty good part of how we are able to make the analysis so efficient is by using these letter grades, which you'll see pretty much right now. So we're almost ready to go ahead and get into the Chicago Multifamily Analysis template and start actually breaking down a real life property. But before we do, I just want to clear up some terminology and definitions to make sure that we're all on the right page and know what these terms actually mean. Quick vibe shift here into more of a slideshow situation. This will only be a couple slides though, don't worry. So I wanted to touch quickly on what the different investing strategies are. So a lot of you out there, if you found this, you're probably interested in one of the first two, maybe one of the first three. That's a house hack, which would be living in one of the units and then renting out the other 1 to 3 units, depending on how many units the building has, to go ahead and offset your mortgage costs or other costs. That's a very popular strategy to have for 2 to 4 unit properties. And then there's your long-term buy and hold if you're just buying this property strictly as for investment purposes. There's a fix and flip, which can be a little bit riskier if the market takes a quick turn or if your rehab costs go higher than you thought, or the timeline of that goes higher than, longer than you thought before the financing that you got for the fixed part of it is due, things like that. There's a bit more variables at play there. The fix and hold, which, is exactly as it sounds, kind of a mix of numbers 2 and 3. Burr, which is very difficult to pull off, but basically that means you buy a place, you rehab it, you rent it, you refinance it, and then you repeat it. We can go into that in more detail. It's not really the venue for it here. I say not Airbnb because this is really hard to do Airbnb. A lot of people get into real estate thinking that they're going to buy some 2 or 3, 4 unit property and rent out put all of them on Airbnb. The city has made it very, very difficult to do that. Although there are some ways to be a little bit more creative than just your standard 12-month leases. There are renting by the room. There's midterm leases, things like that people have had pretty good deals of success with. The financing is going to be a big part of this. So that's going to determine in large part what your interest rate is, and at least in service of what you're going to be putting into this calculator when we get to it. And it's also going to factor in a lot, obviously, on what your down payment is. So cash, 100% down payment. You're not financing it at all. Conventional, you can do as low as 5% down if you're going to be an owner occupant. If you are not going to be an owner occupant, you are still stuck pretty much 20% down minimum. And I should also note here, I'm not a lender. I'm not a loan officer. I'm not in the lending field at all. But, obviously I have been around these transactions quite a bit and have a pretty good idea of what's going on with them. These things do change from time to time. Like this new 5% down thing, that's only been around for about a year and a half. So that's still a pretty new thing that a lot of people don't know about, that you can put 5% down for conventional financing on a multifamily building. Because before that, FHA was really the only way to do that, to put less than 20% down as an owner occupant. But conventional's caught up to it, which is a pretty big deal because FHA has a lot of different other little annoying requirements and things like that can make transactions, that can muck them up. But in general, though, VA, you can put as low as 0% down. And then there's a bunch of other ones, some more niche ones, portfolio loans, bank statement loans, DSCR loans, which we can talk about a little bit, physicians, hard money, etc. But it's important to know what your financing is actually going to be. And really the best/only true way to do that is to talk to a loan officer. And if not, fill out the application and get actually a full pre-approval done. At least talk to them. A lot of times they can kind of take in some information and give you a pretty good idea of where you are and give you a roadmap of how to get there. Get to a better place where you would be able to finance a place if you're not quite there yet. Important metrics of success. All right, so we are going to be playing with these numbers in real time here in a second, but I just want to take a quick second to make sure that we know what they are. So, you probably know all these things already. They're kind of pretty self-explanatory, pretty intuitive, but just in case not, I want to make sure we're all on the same page. So net operating income, that's going to be NOI. That is gross annual operating income minus gross annual operating expenses. So that's pretty simple. Capitalization rate, aka cap rate, that's going to be the net operating income, the NOI, divided by the current value of the property. Cap rate is a very important term in real estate investing. Pretty much, I would say that's the most widely used, ubiquitous term in all of real estate. If you go and talk to somebody about a real estate investment that you are thinking about making, one of the first questions that person, if they're also in the world of real estate investing is likely to ask is, what's the cap rate on it? And, or what's the cap? They'll drop the rate because it's just like that common of a phrase to use, like, oh, it's a 6 cap, I bought a 9 cap in Rogers Park the other day, whatever, so very, very common phrase to use there. Very important term to know that one inside and out. Then there's your debt service coverage ratio. That's a DSCR that some loans can be based off of. So that's your NOI divided by your annual loan payments. So basically, like a DSCR loan would basically just be like they'll give you a loan as long as the property has a positive DSCR, meaning that it makes more than the debt payments. Your cash flow positive. Speaking of cash flow, NOI minus your annual loan payments. So the inverse of that a little bit. Usually quoted in monthly terms. And then there's your cash on cash return, which is one of my favorite metrics to go off of because this measures your cash flow in relation to the money that you actually have in the deal. So one of the most powerful things about real estate investing is the fact that you can use leverage. You can buy $1 million property with $50,000. You know, that's just a crazy thing to think about when you consider there's not really too many other assets out there that you can buy like that have the ability to make you money and grow and have the same safety profile as real estate. Then there's a principal reduction, which is just the amount of principal reduced on the mortgage loan in a given period of time. Appreciation, which is the positive change in the value of a property, which can be forced, aka like you buy a place and you do some renovations and now it's worth more, or just market driven, which is just like you buy a place, you don't do anything to it at all, but 5 years later it's worth more just because it's worth more. And obviously appreciation can be negative as well. You know, it's never all up and to the right. There's going to be jagged along the way. That's going to be expected, but over time there should be a positive change in price, as long as you're sticking to the fundamentals. And then there's a total return on investment, which is going to be your cash on cash return plus your principal reduction plus appreciation. And that's not even getting into all of the different tax benefits and things like that, which we're not going to get into at all in this video, but they are indeed very important. With all that being said, we are now ready to go into the Chicago Multifamily Analysis templates. So let's go ahead and do it. Gonna click on it and ta-da, here it is. All right, the first thing on your end that you're going to notice when you pull this up, everything in here is just a placeholder, by the way. Like, don't worry about any of these numbers. They're just random numbers that I put in here. We'll be going in and changing these. These do not represent any specific property at all. But the first thing that you're going to notice when you get in here is that you can't actually do anything to it because this is the one that I'm sharing to the whole entire world. So if all of you were able to come in here and use this for all of your different properties and things like that, it would be chaos and nobody could use it. So I'm the only one that can use this version of it. But once you open this, you can just follow these directions right here. Go to File, go to Make a Copy. I would recommend that you put the name of the property that you are looking to analyze in here, which I will go ahead and spoil that we are going to be doing 5514 West Berenice. So let's go ahead and just do that and then make a copy. And I would recommend that you do that for every property that you do. Otherwise, especially at least, if there's a property that you think you might want to come back to and keep in mind, I would recommend that you just make a new copy every time that you want to evaluate a new upcoming property. Make sense? Also, obviously, this is a Google Sheet. If you are more of a Microsoft Excel person, you can come here, download as a Microsoft Excel spreadsheet. If you don't have any access to Google stuff at all, just shoot me an email and I'll send you this template as an Excel spreadsheet. We can figure that out, no problem. Okay. So the property that we are doing is 5514 West Berenice Avenue, which sold a few weeks ago. As of the recording of this video, it was in Portage Park. I had nothing to do with this building at all. I never went there in person. I did do a little video about it that is on YouTube. So the listing agent, who is Rose Alvarez, already gave me permission to talk about this property on online. So much kudos to her and congratulations to her for selling it. Seems like a good property. So for our purposes though, let's go ahead and go through some of the photos here just so we know what we're dealing with. Again, this is in Portage Park. Has some nice wooden floors, got the kind of vintage trim, but tasteful. So a lot of times you see these kind of like vintagey apartments and it just looks vintage as a synonym for just kind of like old and crappy, but that's not what's going on here. It's still pretty nice, kept up pretty well. Everything looks good. Nice, nice kitchens, all the appliances you need. Nice neutral colors that people are looking for nowadays. Nice and roomy, wide hallways, big-ish bedrooms. Lots of dining space. That's fairly rare to find. got an actual hood in the kitchen on one of these units. That's rare to find in a rental grade unit. This looks like the basement unit, which also has a hood and things like that going on. So that's for a garden unit, basement unit. That's a really nice looking unit. Basement's in good shape. Outdoors in good shape. Little gangway there. Yeah. Overall, yeah. So that's what we're looking at. Got your floor plans. It's a nice property. So all this being said, let's go ahead and start. Let's pretend that this is still on the market and that 565 is simply just the asking price. So in the beginning, I promised that we can do, obviously I'm taking my time going through this. Once you get good at this, you can just knock this out in a couple minutes using really only a couple key pieces of information. Those key pieces of information that you need are going to be the price. So the 565, let's go ahead and put that in here. The number of units, it's 3. We already know that. Or I guess we didn't know that. But we can go down here and see that it is. And this is on Zenlist, by the way. This is how properties look on Zenlist. So these are the unit types. So we got unit 1, a 2-bed, 1-bath, unit 2, a 3-bed, 1-bath, and unit 3, a 1-bed, 1-bath. And I believe unit 3 is the garden unit. So 3 units. 3 units, and there was one that is rented right now on a month-to-month, but I'm still going to look into it a little bit because my hunch is that this is going to be a little bit below market and it's month-to-month anyway. Might have been a friend of the landlord or a family member, who knows. So the first thing that you needed to know was price. The second thing is the neighborhood that it's in. So we have right here, it says Portage Park. We're going to come down here and we're going to come over here to neighborhoods, and we're going to this bottom tab right here. We're going to come down here. We're going to find Portage Park. The MLS area codes, you don't really need to know what that means, but basically it's the code that they give these different community areas on the MLS, just as it sounds. So where is Portage Park? If you're having trouble finding it, you can actually come here and sort. That's a little easier to find that way. So Portage Park is 8015. So we'll come back over here to the property tab. 80. And now these are all scrambled because I scrambled them on the other tab. 8015. Here it is. Okay. So what this does is, remember those investment grades. So they're calling Portage Park a B+ neighborhood. So what that's going to auto populate some of these fields down here. So like vacancy rate, they say that a B+ neighborhood would on average have a vacancy rate of about 6%. It'll impact the insurance rates, the maintenance budget, and the CapEx budget. Maintenance budget being like your day-to-day stuff, CapEx budget being like you're saving up money for new roof or big capital expenditures. And it's also going to impact the average appreciation rate. So they're saying that a B+ neighborhood should on average appreciate about 3.5% per year. So you'll need to know that. And then the last, the next thing anyway that you would need to know is the taxes. If you don't know the taxes, or if for some reason, maybe you're dealing with an off-market property or something like that, and the taxes aren't listed, or if the taxes are listed, but they have so many exemptions on them that they're crazy low, and like they have like a senior freeze on them or something like that, something that you wouldn't qualify for if you were to buy it. I have this 1.5% here as a placeholder because on average, if you just multiply the purchase price by 1.5%, that it can typically get you pretty close to what the taxes are. That's not foolproof, but give or take, that is usually pretty close to what it's actually going to be. But in this case, we do know because it was listed on the MLS and it didn't have too many exemptions on it or anything like that. So I believe it did have a homeowner exemption, which changes things a little bit. But in any case, we can still go ahead and use it. And so it's 8166. So you would come here, put that there. See, yeah, it was only about a couple $100 difference between the 1.5% and what it actually is. And without the homeowner exemption, that actually probably is about what it would be. All right. Now we have the rents. All right. So the rents are going to be the last thing that you need to know. Those were fake placeholder rents, so we can just delete those. The current rents versus pro forma rents. So pro forma is basically just like a fancy way of saying this is what it could be, projected, etc. There's a couple. If a place is fully rented out right now, you can go ahead and put current rates in here, and then, but maybe if you think that you could spruce the place up a little bit, do some cosmetic rehab, something like that, you can see what the rents might go for if you were to put a little bit of elbow grease into it. But for now, since there are really no real current rents, not really, we're gonna be kind of doing some guesswork on all of these. So remember Rentometer. Let's go ahead and pretend that because I did a little bit of prep beforehand, so let's go ahead and pretend that I put the address in and the bedrooms and baths for all of these, and the kind of report that it's going to generate for you is going to look a whole lot like this. So the single bed, single bath, which in this case, this is the bottom unit, the garden basement unit, in this area within 0.75 mile radius, 18 months. We prefer it to be a little closer to 12 months, but sometimes you have to go a little bit further out just to get enough comps to get a good data set, but that's okay. The median is 1350, but considering that even though it's a really nice basement unit, I would skew a little bit more closer to the 25th percentile. And that's what I like about Rentometer. Just a quick tour through this Rentometer report. I really like that it gives you percentiles and these nice charts. So there's this historical chart. This goes back 3 years, so you can kind of see what the price trends are. You can see how different bedroom counts compare to each other, rent distributions, things like that. But the percentiles is what I use this for the most. I like that, if this place looked really dingy and just crappy, I would come here and look at pretty much everything as the 25th percentile or maybe the 10th percentile and use these numbers here. Or if it was like new construction or just really crazy nice, like super well renovated, I would probably linger over here closer to like the 90th percentile. You can also come down here, this is the area where these are all being pulled from. And here's the specific properties that they are using. So you can come here and, look these properties up, see if they had a listing or something, see if you can find pictures of them, see how they actually compare to the apartments at hand here. But in any case, 1350, that's the median. I guess it's going to be somewhere between the median and the 25th percentile. I would go ahead and I'm just going to throw like 1100 there. I think that's probably pretty reasonable for that one. And then the 2-bed, 1-bath. All the other units are pretty nice. I mean, I would say somewhere between the median and the 75th percentile. Let's go ahead and go with the 75th percentile. I think is fine. So 2150. Again, this is where it becomes a little bit more art than science, and you can play with the numbers. 2150, and then the last one here, 3-bed, 1-bath, between 2100 and 2350. So yeah, 2300. I think that's fine. All right, so once you put those in, you're gonna come over here. So it's still, everything in here is still showing like super negative 3,000 cash flow, but that is because you need to come here and do this drop down right here where it says current. All of these are based on the current, which is not populated by anything. But if you come down here, drop down arrow, hit pro forma, now all of a sudden it shows a positive monthly cash flow of about $1,000 per month and a cap rate of almost 8%. And a GRM. We didn't actually talk about that earlier. So GRM, that's gross rent multiplier. It's kind of just like a different way of expressing the cap rate in a way, but basically cap rate or the GRM is the value of a property divided by the annual rent. So anything that's the lower the number, the better the deal. So anything that's in single digits or low double digits is usually kind of the sweet spot of what you're looking for. And then 8% cap rate, for this area, that would be considered pretty decent for sure. And monthly cash flow at 1,000. Now, again, going back to what your investment strategy is and what kind of financing you're getting, this is based on a 6.5% interest rate. So if you know that your interest rate is going to be different, obviously come in here and change that. And this is also based on a 25% down payment. So if you were coming in here and doing an owner occupant situation, you would want to come in here and change this to whatever you're actually going to be putting down. So let's just go with, 5%, which even at 5% down, you're still cash flowing on this, which is really nice. Relatively rare for this, for this area, honestly. This was a good property, but while you're living in it, you wouldn't be getting this because you would be living in one of these units, right? So maybe to make it super realistic, say you took the basement unit, you would just delete that part. And while you're living in it, you're negative 600 something a month, but you're only negative 600 a month versus the 1100 that you would have been paying if you were renting that same place out, and you're getting all these benefits of built equity and all that kind of stuff, which can be found down here. So remember we mentioned your cash on cash return, which is going to be 8%. Which is basically your cash flow, your annual cash flow divided by the total initial investment. I'm back to the 25% down, so the total investment in this would be about 150,000. And then your principal reduction, which you can come over here to this tab here. This is sort of like your amortization schedule and all this. You can see, you can come in here and play around with like extra loan payments and things like that, and see see how that would impact you going forward. But that's the amount of principal that would be reduced in your first year. This is all just in year one. And then appreciation, if it were indeed to appreciate that 3.5% in the first year, 3.5% of 565 equals this number here, basically like $20,000. And that would then be divided by the amount that you have in it. So overall, the addition of all this, the total return on investment would be around 24% in your first year, which again, like coming from a background of financial advising, there are not too many asset classes, whether you're talking about stocks, bonds, any kind of stock, emerging markets, big cap, small cap, anything like that. Unless obviously there are individual stocks that you could get into that, if you're lucky enough, could beat this. But the amount, this kind of return relative to the relative safety profile and stability of real estate, as compounded again by the amount of leverage that you can get to purchase these assets. I mean, real estate investing is just nuts. It's nuts, the amount, just how good this is for your overall financial health and well-being over time, especially over time. Having a long time horizon on this stuff is super important, because in theory, all these things should just keep getting better. Like your rents should continue to go up if you should choose to, keep up with the market. Obviously, you want to balance having good stable tenants with raising rents on them and things like that. You can just navigate that situation as you see fit. In general, and interest rates might come down. You can always refi, and so basically it's like things change. And very few people, as long as you're sticking to the fundamentals and buying in good areas where there are amenities in the areas that people are going to continue to want to live by, and people are going to want to continue to purchase properties in this area and rent out properties in this area, very few people will be upset that they made an investment like this. I just realized that I've been using the Chicago Multifamily Calculator template this whole time. This will get fixed, obviously, but yeah. So, oops. Anyway, but yeah. So that's how this thing works. This is how it works. You really only need to know where it is, how much it is, what the taxes are, and what the rents are. If they don't tell you what the current rents are, you know how to go to Rentometer and find out what the rents should be or could be based on the current condition of the property, or the condition of the property that you think you could put it up to. This is this is the field for renovations. If you think that if you're a handy person, or feel like you have that desire to put some renovations into it, you can go ahead and put that number right here. Let's go ahead and say, say you wanted to put 100 grand of money into it there. This would reflect in other places, and mostly, yeah, like this would reflect on like cash on cash return and overall return and things like that, because your total initial investment is higher. Things like that. Here, this would be a good thing to pay attention to, the PMI. So if you're putting less than 20% down, you'll be charged a private mortgage insurance by most lenders. And I don't have a placeholder here because it varies very widely based on a number of factors. So that would be something to get from your lender, just kind of what this number should be. So do factor that in if you're putting less than 20% down on any of these home owner occupied loans. But yeah, other than that, you can play around with the asking price. You can play around with the down payment. You can play around with the different pro forma rents. If you know the area, and you say, yeah, okay, sure, Scholar GPT, you might think that a B plus area is a 6% vacancy rate, but I know that I can get a 3% vacancy rate because I've done this before, because I have friends there, just because I'm confident, by all means overwrite it. Like, it's fine. These are just kind of averages anyway, right? But yeah. So this is it. If this was a lot and very, if some of this went over your head, that is perfectly fine, perfectly understandable. This was a lot. Go ahead and please don't hesitate to ask any questions that you might have, and please do consider that newsletter. It's I would believe it's pretty much if this is if this is the kind of stuff you're interested in, pretty much could not possibly find a better resource anywhere than that newsletter. I truly believe that. But yeah, so that's what I have now. And I'll end by saying, go ahead, and this last link here is to book a meeting with me. So this would be, once this loads, this is my Calendly link. So I would love to, whether you're a day away or a year away or a decade away from making any decision like this, I would love to sit down and chat with you. We can do Zoom, we can do a phone call, we can meet at the office, we can meet at a cafe, whatever you want to do. I'm open to any of it. I love talking about real estate, obviously. I've been very long-winded on this stuff. Anyway, Jake Lyons at Properties. And that's all I got. I'd love to hear from you, and please let me know if this has been helpful and if you have any questions. All right. Thanks.